Financing a shiny new car can quietly steal six figures from your future, while the boring used car could be your ticket to early freedom. Today I'll show you the real math, line by line, so you never get trapped by a $900 car payment again. New versus used, the real math. Cars are the second biggest expense for most American households after housing, and we're not talking pocket change. AAA estimates vehicle ownership runs into the five figures per year for the typical driver when you add payments, insurance, gas, and maintenance. In late 2025, the average price of a new car in the U.S. hit about $50,326, an all-time high, and early 2026 data still has average transaction prices hovering right under the $50,000 mark. Used cars are cheaper, but still pricey. The average used vehicle in 2025 was around $30,000, and 2026 nationwide averages are reported around $25,000 to $26,000, depending on how you measure it. So if you've ever sat in a dealership thinking, "Am I crazy for even doing this?" No, the numbers really are wild. Today we're going to compare financing a new car versus buying a used one using actual 2024 to 2026 US data, not made-up spreadsheet dreams. We'll talk price, interest rates, loan terms, depreciation, and the one number dealers hope you never calculate: the lifetime cost of that monthly payment. Stick around to the end, because I'll give you a simple set of rules you can screenshot and use the next time you walk into a dealership, so you know in 5 minutes whether that offer is trash or a good deal. Let's start with the big picture. According to Kelley Blue Book and multiple industry trackers, the average transaction price for a new vehicle in the U.S. has been hovering around $49,000 to $50,000 since late 2025 and into early 2026. That includes a mix of sedans, SUVs, and pickups, so that average car now costs as much as a down payment used to cost on a house. A Consumer Affairs and USA Today breakdown using KBB data shows buyers paid about $49,814 to $50,326 on average for a new car around late 2025, with January 2026 still near $49,191. Meanwhile, a J.D. Power and Carfax look at used cars puts the average used vehicle price around $30,202 in 2025, and broader 2026 estimates put typical used car prices near $25,600. So yeah, that average new car? It's basically a rolling luxury apartment with cup holders and a payment plan. Now let's talk about how people are paying for these cars. Experian data for late 2025 shows the average new car loan was about $43,582, with an average monthly payment around $767 at an interest rate near 6.37%. For used cars, the average loan was about $27,500, with a typical payment around $537 and an average interest rate over 11%. Other analyses using Experian and LendingTree data show similar numbers, around $748 per month for new and roughly $532 for used in 2025. Those two numbers, around $750 versus $530, are going to be the villains of our story, so keep them in your head. We're going to see what they do to your net worth over time. Here's where the trap starts. Years ago, a car loan was 3 to 5 years. Today, the average loan length is almost 6 years, and it keeps creeping up. Recent Experian and other auto finance reports show new car loans averaging about 69 to 70 months, and used car loans right behind them, also close to 67 to 70 months. Finance articles and lender data show that many buyers are now taking 7-year loans, and a growing slice are even going 84 months or more just to make the monthly payment fit. Car market commentators note that stretching your loan to 7 to 8 years might keep your monthly payment lower, but it dramatically increases the total interest you pay and how long you're underwater on the car. So when a dealer says, "Good news, we got your payment down to $490," What they usually did was quietly add another year or two to your loan, not magically make the car cheaper. Auto finance research also shows that many buyers are now committing to monthly payments over $750, and a noticeable share are signing up for $1,000 plus car payments, often on regular trucks and SUVs, not exotic cars. That's more than a lot of people's first apartments. If you've ever felt stressed staring at your bank app the week after a car payment hits, you're not alone. The system is basically designed to push you to just a little bit more per month until your car payment quietly eats your future. Let's run a simple but realistic comparison: financing a new car versus financing a used car. First, the assumptions. We'll stay close to current real-world data. New car price. We'll use $50,000, roughly the average new car transaction price in late 2025. Used car price. We'll use $27,500 in line with average used loan amounts and typical transaction prices. New car loan. 69 months at 6.5%. APR. Similar to late 2025/early 2026 averages, around 6.3 to 6.8% for new cars. Used car loan. 67 months at 11%. APR, roughly in line with average used rates around 9 to 11%. Experian's Q4 2025 report shows almost this exact setup. $43,582 financed for new at 6.37% with a $767 payment, and $27,500 for used at 11.26% with a $537 payment. That's about a $230 per month difference between the average new and average used car payment. So here's our key number. New car, about $760 to $770 per month. Used car, about $530 to $540 per month. Difference, around $230 every single month. $230 is not just a couple DoorDash orders. It's a plane ticket. It's a Roth IRA contribution. It's also the price of pretending you needed that new car smell. Now imagine you do this over 6 years. New car buyer pays roughly $770. Times 72 is approximately $55,000 in total payments, using a rounded 6-year term and including interest. Used car buyer pays about $540. Times 72 is approximately $39,000 under similar timing. The exact totals vary with your actual loan term and APR, but the point is consistent with the data. The new car buyer is often spending $15,000 or more extra over a similar period compared with a solid used car, even when the used APR is higher. Hold that $230 per month gap in your mind. In a minute, we're going to see what happens if you invest that difference instead of feeding it to a car. Payments are only half the story. The other half is depreciation. How fast the car loses value while you still owe money on it. Industry data and depreciation calculators show that a new car typically loses around 15 to 20% of its value in the first year, then roughly 40 to 50% of its value over the first 5 years, depending on the model. IC Cars style analyses and similar tools estimate that many mainstream vehicles lose about 42 to 50% of their original value in 5 years. On the high end, some luxury cars and certain EVs have been shown to lose well over half their value in 5 years, with some models dropping 60 to 70% or more, especially when incentives and rapid tech changes hit resale values. On the other end, certain vehicles like popular Toyotas, Hondas, and specific sports cars can retain 60 to 70% of their value after 5 or 6 years. Let's keep the math friendly. Buy new at $50,000. 5 years later, average resale may be around $26,000 to $30,000, depending on model. That's a $20,000 plus drop in value just to own the car for 5 years. Versus a used car. Buy a solid 3-year-old used car for around $25,000 to $30,000. 5 years later, maybe it's worth $12,000 to $15,000. You lost closer to $10,000 to $15,000 in depreciation instead of $20,000 plus. Think about it this way. A lot of people are effectively burning $4,000 to $5,000 per year in depreciation alone on a new car, which is more than many Americans contribute to retirement each year. That's not a car. That's a very expensive subscription to looking successful in traffic. And remember, depreciation is worst in the first few years. When you buy used, someone else already paid for that drop. You're buying the car after the worst of the value destruction has already happened. Now we get to the really nasty part, negative equity, owing more on your car than it's worth. Auto finance reports show that a rising share of trade-ins come in with negative equity, meaning the owner is underwater on their current car when they go to buy the next one. In some recent quarters, analyses have found that roughly 1/4 to 1/3 of people trading in a car toward a new one were upside down on their loans, often by several $1,000s. Experian's 2025 reports show average new car loan balances rising while terms stretch, which makes it easier to end up owing more than the car is worth if values fall faster than you're paying down the principal. Long loan terms, those 72, 84, and even 96-month loans, mean you're in the danger zone longer, especially on rapidly depreciating vehicles. Here's how the negative equity flywheel works. You finance a new $50,000 car long-term. 3 years later, it's worth maybe $30,000, but you still owe $36,000. You trade it in. The dealer pays off your old loan by rolling that $6,000 gap into the next loan. Now you're starting your next car with $6,000 of old debt baked into it. Rinse and repeat every 3 to 4 years, and you're basically paying for cars you don't even own anymore, while also borrowing for the new one that's already losing value. This is why some people feel like they can never get ahead. It's not just rent or groceries, it's the silent treadmill of car debt that never actually turns off. In a minute, we'll flip this around and show you what happens if you never roll negative equity and instead keep a paid-off used car while investing the difference. Let's walk through a simplified story similar to what researchers and finance educators often highlight. Imagine Alex and Jordan, same age, same job, same salary. At 25, both decide they need a nice car. Alex finances a brand new car at around the current. Average. Price, $50,000. Loan, about $43,500, financed at roughly 6.4 to 6.8% over about 69 to 72 months, giving a payment close to $760 to $780. Insurance is higher because it's a newer, more valuable car. Jordan buys a 3-year-old used car. Price, $27,500. Loan, financed at around 9 to 11% over about 67 to 70 months, with a payment around $530 to $550. Insurance is lower because the car is older and cheaper. The monthly difference is roughly $230 in payments, plus maybe $40 to $70 less per month in insurance and taxes for the used car, depending on the state. Let's conservatively say Jordan frees up $250 per month total. Here's the twist. Jordan Auto invests that $250 every month into a low-cost index fund instead of letting it disappear into the car payment. Over 10 years, if that investment returns around 7 to 8% annually, which is in line with long-term stock market averages after inflation used in many planning models, that $250 per month can realistically grow into tens of thousands of dollars, often in the $40,000 to $45,000 range depending on exact returns. Meanwhile, Alex trades in the new car around year 6, rolls a chunk of negative equity into the next new car, and keeps a high payment going the entire decade, something we know is common from the rising loan lengths and balances in the auto data. So 2 people can have the same salary. One has a somewhat nicer car and chronic money stress. The other has a perfectly fine used car and an extra $40,000 to $50,000 in investments by their mid-30s. That's the real cost of buying new when you don't need to. 10 years later, Alex has memories of new car smell. Jordan has memories of clicking refresh on their brokerage app with a big grin. Now, I'm not here to say nobody should ever buy a new car. There are situations where new can make sense if the math and your life line up. Car price data and total cost of ownership tools show a few patterns. High resale models. Some vehicles, like certain Toyotas, Hondas, and specific SUVs and sports cars, retain 60 to 70% of their value over 5 to 6 years. For these, the depreciation hit is smaller, and sometimes the new versus 3-year-old price gap is tighter. Low or 0% financing promos. In some periods, manufacturers offer genuine 0% or very low APR on slow-moving models. In 2025, only a small slice of new loans had true 0% rates. But for those buyers, the interest savings could tilt the math toward new. Business use and tax deductions. For people legitimately using vehicles as business assets, tax rules like Section 179 or mileage deductions can change the effective cost. Long-term keepers. If you truly drive a reliable car for 10 to 15 years, the annual cost can come down a lot, especially for models with slower depreciation and good maintenance records. The problem is, car companies market every new car as if it's in one of these special categories. Most aren't. Also, interest rate data shows that only buyers with excellent credit are getting the best rates, something like 4 to 5% for new cars, while many others are stuck paying 7 to 11% even on new vehicles. So the cheap loan story only holds if your credit is actually great. If you're already stretched, chasing a brand new car because I deserve it is usually code for I'm about to donate thousands of dollars to the dealership's profit line. Let's turn this into a checklist you can actually use. Step 1. Know your limits before you shop. Look up your credit score and use an auto loan calculator or lender tool to see what your realistic interest rate and payment would be at 60 months and 72 months. With a conservative car price, aim for a payment that's 10% or less of your take, home pay, including insurance. Step 2. Compare total cost, not just monthly payment. Take 2 real cars you're considering, a new and a used. Use sites like Edmunds, CarEdge, or Consumer Affairs to estimate purchase price interest paid over the loan term at your likely AP insurance, fuel, and maintenance over that period. Expected resale value after 5 to 6 years. Subtract the resale value from the total to get your true cost of ownership. Step 3. Calculate the invest the difference scenario. Take the payment difference between the new and used options, maybe that $230 a month, and run it through an investment calculator at 7 to 8% annual return over 5 to 10 years. Ask yourself, is the new car smell worth this much future money? Step 4. Refuse negative equity. If your current car is underwater, seriously consider keeping it longer, paying it down, or selling it privately, and making up the difference, instead of rolling the balance into a new loan. The moment you stop rolling negative equity, the treadmill slows down. Step 5. Get pre-approved. Auto finance research shows dealers often mark up interest rates above what the lender actually approved to keep the spread as profit. Getting a pre-approval from your bank or credit union gives you a benchmark so you can tell if the dealership's great deal is actually worse than what you already have. Think of it like dating. If you walk in knowing your worth, you're a lot less likely to say yes to a terrible offer. So, financing a new car versus buying a used one isn't about which is morally right. It's about what the math says when you plug in today's prices, today's interest rates, and your actual life goals. For most people in 2024 to 2026, with new car prices around $50,000, used cars in the mid-20,000s to low 30,000s, and average loans near 6 to 7% for new and 9 to 11% for used, the numbers say this: a smart used car plus investing, the difference quietly beats a shiny new car plus 7 years of heavy payments, over and over again. The car you drive for the next 5 years matters way less than the freedom you buy for yourself over the next 20. Future, you does not care what you drove at 28. Future you cares whether you're still making payments at 48. Drop a comment. Are you team new or team used after seeing the math? And if you want more deep dives like this, where we run the actual numbers behind everyday money decisions, hit subscribe so YouTube knows to send you our next breakdown. Drive safe, do the math, and thank you for watching video. I'll see you in the next video.